Hello everyone, welcome back to our channel. Today we've got some exciting updates from the world of cryptocurrency that you don't want to miss. Let's dive right in. First up, big news from the SEC. New chairman Paul Atkins has unveiled a pro-innovation agenda, marking a significant shift in how the agency approaches cryptocurrencies. He is committed to championing innovation by integrating crypto markets and drafting formal rules. This is a clear critic of the previous regulation through enforcement strategy. Key changes include the dissolution of the FinHub office and exploring the possibility of allowing SEC registrants to custody both securities and non-securities. This decisive break aims to foster trust and embed innovation within the Commission's culture, potentially reshaping the regulatory landscape for digital assets and unlocking new investment avenues. Next, let's talk about the Genius Act. The Senate's long-stalled stablecoin legislation has cleared a critical procedural vote, moving closer to full floor consideration. This bill establishes a federal framework for issuing stablecoins, which is crucial for broader crypto adoption and institutional investment. Despite earlier opposition, key Democrats have reversed their stance. New provisions now address presidential conflicts of interest and ban big tech firms from issuing stablecoins if they monetize sensitive user data without consent. This legislative progress, partly driven by industry lobbying, could unlock billions in digital asset investment. Now, let's look at Asia. Ultra-wealthy investors are increasingly moving away from the US dollar, favoring Bitcoin, gold, and Chinese markets due to rising geopolitical instability and market volatility. According to UBS, over 15% of its Asia-Pacific high-net-worth portfolios are now allocated to crypto and gold, a significant increase from previous years. Singapore is leading the diversification trend, with many wealthy investors planning to increase their crypto exposure. This shift reflects a growing distrust in the dollar's dominance and a strategic re-evaluation of asset allocation, highlighting Bitcoin's emerging role as a hedge asset. Moving on to Binance, the world's largest cryptocurrency exchange. They've asked a US federal court to dismiss a class action lawsuit, citing a binding arbitration clause in their user agreement. The lawsuit alleges that Binance promoted unregistered digital tokens and misled investors. This legal move follows a fluctuating court ruling on the enforceability of arbitration. Binance argues that plaintiffs accepted terms mandating private arbitration under Hong Kong rules. This legal battle is part of broader global regulatory scrutiny for Binance, which recently settled a $4.3 billion US compliance case. Lastly, Bitcoin treasury firm Strategy and co-founder Michael Saylor are facing a class action lawsuit alleging federal securities law violations. Investors claim the company misled them about profitability and Bitcoin exposure by overstating financial performance under new accounting standards. The suit accuses Strategy of highlighting gains while omitting significant unrealized losses, misrepresenting the volatility of its $59 billion Bitcoin position. Strategy, which holds over 500,000 Bitcoins, intends to vigorously defend against these claims. Let's take a look at the economic indicators for this week. First up, US crude oil inventories. The forecast was a drawdown of 900,000 barrels. Instead, we got a sharp increase of 1.33 million barrels, way up from last week's 3.45 million. This signals weaker than expected demand or a ramp-up in supply. Either way, it's a bearish sign for the energy markets and could put downward pressure on oil prices. The 20-year bond auction showed a yield of 5.104%, up from the previous 4.81%. That tells us investors are demanding a higher return, likely due to inflation worries or cooling demand for long-duration debt. It's another hint that financial conditions may be tightening. On the labor front, initial jobless claims came in at 227,000, slightly better than the forecast of 230,000 and down from the previous 229,000. It's a small improvement, but it reinforces the message of a resilient labor market despite ongoing macro headwinds. The manufacturing PMI jumped to a 52.3, beating both the 49.9 forecast and last month's 50.2. That's a clear signal of expansion in the manufacturing sector, a strong indicator of industrial recovery and momentum. And the services sector is also heating up. The services PMI came in at 52.3, above the 51 forecast and last month's 50.8. That suggests growing demand across service industries, which could support broader GDP growth. But it wasn't all good news. Existing home sales dipped to 4.00 million, falling short of the 4.15 million forecast and slightly below last month. This points to a possible cooling in the resale housing market, potentially due to higher mortgage rates or affordability concerns. In contrast, new home sales jumped to 743,000, well above the forecast and last month's 670,000. Strong demand for new homes suggests buyers are still active in the market, likely drawn by builder incentives or tight supply in the resale market. Next week, market attention will be focused on key economic indicators and earnings reports, including durable goods orders, CB consumer confidence, quarter-on-quarter GDP, S&P Global Services PMI, and core PCE price index. Meanwhile, several major corporations are set to release their earnings reports, including Nvidia Corporation, Salesforce, Costco Wholesale, Okta, C3.ai, Synopsys, Dell Technologies, Best Buy, Burlington Stores, and Abercrombie & Fitch. And that's a wrap on today's crypto news update. So, to sum it up, energy markets show signs of weakness, but both manufacturing and services are showing strength. The labor market remains solid, while housing gives us a mixed picture. What do you think these signals mean for the Fed's next move or your investments? Let us know in the comments below. Don't forget to like, subscribe, and hit that notification bell for more updates. Thanks for watching, and we'll see you next time.